Good day everyone, welcome to Arthgyaan. In this video, I'll discuss a question on diversification from an NRI investor who has 8 crores in just 2 US tech stocks. My name is Shayan Sharkar and I am the author of Arthgyaan. Arthgyaan is a website providing you with the right knowledge, tools and 1:1 guidance to create, manage and execute your portfolios. Before getting started, please put in a comment below as to what you think the investor should do in this case. This is a question that came to me from Reddit. So this investor has put up this particular question. There's no further detail apart from this and some other detail in some comments which I've collated. So they're living abroad. They are actually in Europe and not in the US. And this point is important because having US citizenship or green card or even residency would imply different types of taxation which Europeans would not have, European NRIs would not have. So I'll come back to that later. So they have around 8 crores in two stocks, 4.5 CR in Microsoft, 3.5 in Google, plus rest of the assets. It adds up to 15 as per this particular comment, but if I go, since I went through the whole thread, it adds up to actually 17. I've captured that here. So 8 crores in the two stocks plus other investments, some land, SGB, PPF, ULIPs, all that. So that's adds up to 17 crores. So 17 crores is around 2 million US dollars or slightly less in euros, so around 1.9 million euros. So that's not a small sum, but that's what they have right now. And half of that, almost half of that is in just two stocks. And that's the premise of this video. So, just quick point, ULIPs, not good investments for anybody. There's no reason to invest in ULIP ever. Only ULIP sellers will tell you that it's a good investment. So if I look at the asset allocation of this portfolio, they have around 75% in equity, 10% in debt and 15% in cash. That's the high level overview. And if I look at this particular quote of Warren Buffett, because like we know, we all love Warren Buffett quotes for personal finance. So diversification preserves wealth, but concentration builds wealth. We'll actually flip this on its head, and we'll see that this in this situation, concentration has built wealth. So they've reached a very large figure solely due to concentration in particular two tech stocks, and diversification is the next logical step for that. So we'll look at this visual is from Money Visuals. It's an excellent page on LinkedIn. They have a Twitter channel as well. So this, if you look at this diagram, essentially this shows various different investments, various asset classes. And if you follow this one, any one of them, we take the purple one. So it has been here at the beginning, near the top, then it went to the bottom, stayed in the bottom for 3 years, then again went to the top, then again went somewhere in the middle. And you will see this trend with any of these particular investments. So none of them have stayed consistently near the top or the bottom over this period, except if you look at this diversified portfolio, this gray one. So this gray one has slowly stayed mostly in the same place in terms of overall. So what does this mean essentially? Diversification, will it give you the best results? No. Will it give you the worst results? No. And both of these are equally important if you want to diversify your portfolio. So again, this gray one, it has stayed in the middle. And when you have created a large amount of wealth, preserving that wealth is important, and average returns by a diversified portfolio is the main thing to do. So how will we do this? We'll use the Arthgyaan goal-based investing calculator, which I'm going to show to you right now. I set it up based on based on the data that was provided earlier in the screenshot, and 17 crores of assets. And let me just show you how that works. Yeah, so this is the tool. I have put in the assets here. So Google, Microsoft, this is the US investment. So plus the cash, 2 crores of cash, Indian mutual funds, plus the rest of it. Total it adds up to 17 crores. So this is the balance, and this is around 17 crores. So goals, I have taken only retirement goal for now. I've taken an early retirement goal for around 40 years, and total retire and additional full retirement for 40 years. So that's 54 years of retirement I'm modeled. And once I've hit the calculation, I would complete the calculation, and it shows around 5.5 lakhs of SIP required to reach that goal, which is similar to what they're doing right now. They have 4.7 lakhs. So SIP happening right now. So this is in line. But here the main point is that if you look at the asset allocation in the middle of the slide and then make this slightly bigger to make this easier to see. Yeah. So if you look at the asset allocation here, so they have this, what they have right now, 75%, 10%, and 15% in equity, debt, and cash respectively. Almost 13 crores in equity. And this has to reduce. So it's all depends on their actual goals, but whatever be the goals, this amount, the equity allocation is a little on the high side. So in this particular case, it's 50 to 48 equity to debt. So 13 has to go down to 9. And this reduction by 4 crores, that will have to come from the concentrated position. So this is their current and target asset allocation. So cash, equity, and debt, it's all there's a reduction, and this tool actually shows you the split as well. So equity, debt, and cash, and based on goals which are in various time buckets. So 5 to 10, 10 to 15, 15 plus, and so on, and same for debt. So this is the split, and if you wish to understand how to split this into what kind of equity, what kind of debt, so that's there's a link in the description which will allow you to contact me. So get in touch. I can help you with that particular idea. And here the tool also shows you the corpus is around 53 crores required for retirement and all that. So this includes early retirement and full retirement. So 54 years of retirement in total. And it has present corpus term insurance coverage. So in case the person dies before this time, so they need around 7.5 crores to cover their liabilities, not liabilities per se, but their unfulfilled goals. So they still have 21% left to go in terms of the portfolio. So that is the gap which is being covered by term insurance. So this tool will help you to do all of that. It's a paid tool, and I'll leave a link for this particular version in the description section. So you'll get the same video which you can, same sheet which you can then modify and play around. And if you need a license, there's a way to get the license from here. Here's get the license, so you can get that done. So yeah, model setup, output, I've covered this. So again, this is how the model portfolio is going to be split. And this is, let's come to practical considerations. One is diversification will require selling. Selling means capital gains tax. Wherever they're selling it, they'll have to pay tax there. If the stocks are held in the US, they'll have to pay tax in the US. If they're held in Europe, they have to pay taxes in Europe. That's unavoidable. But if we look at this visual, again from Money Visuals on LinkedIn, so this is one of the good ones because it gives you the premise of capital gains. I mean, if you invest here, this is the money which you have invested, total invested cost basis, and this is the unrealized gain. So this is the whole thing which you have got due to the stock going up, right? So you have to pay taxes, and paying taxes would be a good thing because you have got this return. If you did not get this return, you will not be paying this taxes. So even you'll have something left after paying the tax. So that way, it's unavoidable. I mean, how to do this in practice? You want to sell, let's say, 2% a month. 2% a month will deplete the position in around 50 months, 4 years. 10% will be quarter. That's another way of looking at it. 10% would be like what? 10 quarters, 2.5 years, slightly more around that. And or one go probably would not be a good idea. It's just, you'll be hit with a huge tax bill at one go, and any market movements will give you a lot of regret. Why did I do this types regret? So that's not ideal. Where to invest? I've covered this in a recent video, rather last week's. I'll link that video here. So this gives you options for European NRIs, European, Indian, and global stock markets, which would include US stock markets. So I'll link that video now, and that will give you the right idea of what is the best situation right now. So that's it. Thank you all, and I'll see all of you in the next video. Bye bye.